A guarantor mortgage is a way that a loved one can increase your affordability or deposit in return to agreeing to take on shared responsibility for your mortgage debt. Put simply, the guarantor's role is to act as a backup in case you cannot make your monthly repayments. Today, there are lots of different guarantor mortgages which allow friends and family to help you get on the property ladder. When taking out a guarantor mortgage, your guarantor would need to go through full affordability checks to ensure that they are financially able to support your purchase. Once that's done, a mortgage will be taken out where the guarantor offers up collateral to the mortgage lender as security for the mortgage. This security comes in the form of savings, income, or property. It won't be touched unless you default on your mortgage. When you remortgage in the future, if it's financially viable for you to do so, you can remove your guarantor from the mortgage. There are various types of guarantor mortgages. Here, we're going to cover the top 3. Also called an income boost or a joint borrower sole proprietor mortgage, this works by adding some or all of a family or friend's income to your own to increase the total income. Because your combined income will be higher than just yours alone, you can borrow more for a mortgage. In doing so, your loved one is agreeing to be jointly responsible for the mortgage payments, but they won't be listed on the property deeds. This makes you the sole owner and means any stamp duty relief you would qualify for as a first-time buyer is unaffected. Plus, as long as you make your mortgage payments each month, your guarantor won't need to step in to help. But if you miss repayments, your guarantor will be legally obliged to pay. The second guarantor mortgage type is a savings and security mortgage, also known as a springboard or family guarantor mortgage. Your family member or friend will deposit 10% of the home purchase price into a special savings account that's held by the lender for a set number of years. As the buyer, you can also choose to put down a deposit up to 9.9% or can avoid a deposit altogether. As long as you make your mortgage payments each month, at the end of the fixed term, your guarantor will get their savings back, plus any interest that has accumulated. If you don't make some of the repayments, that money might not be returned to your guarantor. The third type of guarantor mortgage is when the guarantor's property is used as security. This means your guarantor agrees that their property is used as collateral if the buyer is unable to pay. These are not very common anymore amongst lenders, so the options are limited. Plus, it can be scary for guarantors to offer their property up. If you have a homeowning friend or family member who wants to help you buy, a good alternative is a gifted deposit boost. This involves releasing money from their home to gift to you as a deposit, or to add to your current pot. It works by setting up 2 mortgages, a first-time buyer mortgage for you and a smaller mortgage for your helper. We like to call them boosters. The money that's raised by your booster's mortgage is the cash that you will use for your house deposit. Because there are 2 mortgages that are separate, this is technically not a guarantor mortgage because your family member isn't liable for your repayments if you cannot make them. Your booster will have to make monthly repayments for the smaller mortgage that they are responsible for. However, a deposit boost is a way for family members to help younger generations get on the ladder without needing mountains of cash in the bank. With a bigger deposit, you can get access to lower mortgage interest rates and make your monthly repayments more affordable. In fact, our average deposit boost user saves £17,000 over the 5 years in interest fees alone. If you want to find out more about guarantor mortgages and which ones may be right for you and your family, talk to Tembo.